Ladies and gentlemen, it's a great pleasure having you here for the Q3 advisory board discussion featuring the one and only Jim Rickards. Jim, thanks for taking the time again.
Glad to be here.
Then there's Mark Walek. Hi, Mark.
Hey, Ronnie. How's it?
And then there's an internal special guest, Christian Scherer, who's a partner at Incrementum and a real expert on the topic of energy and especially uranium. Hi, Christian. Thanks for taking the time.
Hi, Ronnie. Pleasure is on my side.
So, Mark, you are currently with your parents in Austria. Jim, where are you currently?
I'm coming to you from the oldest seashore resort in the United States, Cape May, New Jersey. It was founded in 1626, and I'm staying in a hotel that was built in 1813. So we're definitely, it's back to the future.
But for European standards, that's still pretty young.
Well, yeah, depending on the country. Switzerland, yeah, I agree with you. Switzerland is old, but we'll take 400 years. That's pretty good by U.S. standards.
And Christian is currently on vacation. Sorry for bothering you, but thanks for taking the time. And you're in Ticino. What is it in English? Ticino. So that's the Italian part of Switzerland. A really lovely area.
Italian-speaking part of Switzerland, and I'm sitting here near the Lago Maggiore, approximately 20 kilometers from the borderline to Italy. That's
where all the gold refineries are, right?
Yeah, they are sitting more south.
Lugano, yeah.
Near between Lugano and Chiasso. Mendrisio, that is the place to be for them.
It's a beautiful place, and therefore thanks for taking the time again, Christian. Let me briefly introduce you. So Christian is a partner, an equity partner at Incrementum, and he's responsible for special mandates, and most importantly, he manages the Uranium Resources Fund, one of the very few funds worldwide that invests in uranium energy. Christian studied business administration at the University of Zurich, and while working, obtained a PhD at the Department of Banking and Finance at the University of Zurich. His dissertation was on the subject of the investment strategy of Swiss pension funds in the property sector. He has gained comprehensive know-how in financial markets by working across various functions as investment advisor, broker, and portfolio manager. Since summer 2004, Christian has focused on various investment topics revolving around assets as entrepreneur, advisor, and portfolio manager. He contributes his practice-oriented financial markets expertise as member of the advisory board of several companies. He's married and has a son, and in his spare time, he likes to cook for friends and family. You haven't cooked for us recently, Christian?
Yes, I mentioned for friends and family. But at least your family. So well, let's hope we get a chance to do that in coming months.
So thanks for joining. I think it's going to be a very, very interesting discussion. As usually, I would like to start with some housekeeping. Well, we released our new In Gold We Trust report end of May. It is quite an extensive publication. Again, 350 pages about the topics, obviously, of inflation versus deflation, commodities. We talk about the mining space, central bank action, and so on. You can download it for free on our webpage, as usually. We also do publish the In Gold We Trust nuggets. Those are dedicated special chapters of the report, and the In Gold We Trust classics. We will publish our In Gold We Trust chart book very soon. Our friend Peter Young has started Twitter threads about special topics of the report. I think they're highly interesting. So that was basically the main thing in the second quarter for us. Now we look forward to taking some time off and enjoying time with our families. And I think it's going to be a very, very interesting fall for us. Now, I would like to start the discussion with some sort of a macro overview. We see that the economy is clearly cooling down. We saw the Atlanta Fed nowcast growth model for Q2 is down to 7.5% annual rate. It was at 10.3% a month back. The New York Fed model for Q3 is down to 3.2%. It was at roughly 4.5% a couple of weeks ago. We saw a big move in bonds. So I think Dave Rosenberg is really happy now. The volume of bonds globally trading with negative yields has risen to 15.2 trillion, which is up 6.1%. Our friend Kevin Muir just said that the bubble in stupid speculation is over. There are plenty of examples. For example, an Italian artist selling an invisible piece of art for 15,000 US dollars. But we also saw, for example, that the Bloomberg meme stock index has depreciated significantly. We're seeing narrowing breadth in the equity market. So if we have a look at this chart that we will show, the S&P shows that the percentage of stocks above their 50-day moving average has fallen significantly. So the market breadth is very, very narrow. We also see some confirmation from the gold-silver ratio, which has popped hard, very hard recently. And it's taken out the 200-day moving average. We also saw big moves in the commodity space. It was to some degree a crowded trade, probably. I think the commodity super cycle was quoted very, very often. But now I think the big question really is, what's the main reason for this recent risk-off move? Is it the Fed's rather hawkish shift that they started or initiated recently, or is it COVID's variant explosion? And I think a question that I would like to ask Jim is, Jim, if we see that the onset of the Delta variant increases geometrically, what do you think will the response from monetary and fiscal authorities be like? Because I tweeted out this morning, it feels like a bit in the movie Home Alone with Macaulay Culkin. So the markets, it seems it's waiting or it's kind of left alone at the moment, and it's waiting for some sort of a shift from the Federal Reserve and perhaps even more fiscal stimulus. But I don't think that we will see it very quickly, because then I think the Fed, but also politicians would kind of lose their faces. So what tools remain in the box, and how do you see the current risk-off move, Jim?
Well, a couple of things, Ronnie. Everything you said is correct. But if you go back and play the transcript from our last quarterly call, I predicted every one of those things. And 4 months ago, when there was inflation, if you recall, I was the one saying disinflation bordering on deflation. I was pretty much getting laughed at, but I'm used to that. And now it's all coming to pass. You said that Atlanta Fed GDP nowcast has dropped from roughly 10% to 7%. You're right. If you go back before your 10% benchmark, it was 13%. It went 13, 10, 7. So that's an enormous drop. And a lot of people don't understand how the Atlanta Fed calculates that. It's very different from any other forecast. Most people have a model, and it's a set model, and they project forward 3 months, 6 months, whatever it might be, and they kind of update it. But the Atlanta Fed GDP model, GDP now, the reason they call it a nowcast, not a forecast, It's a very different methodology. They say, well, we don't know what the rest of the data is going to be, but instead of guessing what the data is going to be, we're going to take the data we've got and tell you what GDP would be as of now based on the available data, recognizing that we don't have all the data. So no model is perfect, but it's a different style of forecasting than guessing at the things they don't know. They kind of leave out the things they don't know. But what that means is that growth is deaccelerating. This is not just a case of getting the model wrong. Say, whoop, gee, it's only 7%. It's a case that they got it right every time, but that drop is a deacceleration of growth. So what you can do is you can look at the second quarter, and we'll have the first estimate of the second quarter GDP next week. But you can see that there's a big difference between April, May, and June. And that's the point. And that was April. It probably was on track. It probably was at a tempo that would have produced annualized growth of 13%. Now it isn't. So that means, first of all, there's been a deacceleration, not just oh, we got the number wrong. Here's our new guess. There's been a deacceleration, and that current growth is maybe even lower than 7%. So that's a very big deal. Now 7% is high compared to the average annualized growth of 2.2% from 2009 to 2019. So we had almost 11 years with annual growth of 2.2%, which is pathetic. That's what we did. That's what and there wasn't much difference between Trump and Obama. Trump kept saying, "Oh, the greatest economy." Well, nominally, that's always true, pretty much. But there wasn't a big difference in the growth rates there. So you would, after being down 3.6% for the full year, that's not an annualized quarter. We know the number for 2020. It was down 3.6%, the greatest contraction in the U.S. economy since 1946. With that as your baseline, you'd expect much stronger growth this year, and we're not getting it. It wasn't that strong in the first quarter. That was, I think, 5 something. So this is a very weak economy. I think it has almost nothing to do with COVID. I know if you're writing headlines, it's COVID. COVID's serious. I wrote a book on it, and it's a deadly disease, and it should be taken seriously. But the idea of blaming the economic performance on COVID, 2020 lockdown, huge policy blunder. Yeah, okay, but not now. Now you look at Sydney. Sydney is locked down to the point where you're not allowed out of your house. There were a couple of people who got in a car and left town, and they were arrested. They're in jail today for getting in a car and driving out of town. So these masks, we know that masks don't work, but politicians keep saying wear a mask, wear a mask. It's all for show. Those beanies with the propeller that people at Google wear? They might as well, Fauci might as well come out and say, hey, everybody, put a beanie on with a propeller and it'll prevent disease. That's about how effective masks are. So we have all these really flawed policy responses, but it's a mistake, in my view, to analyze the economy through the lens of COVID. COVID's a big deal. I'm not minimizing it at all. I'm saying that we have a weak global economy anyway. It was kind of weak toward the end of 2019. The U.S. has not yet recovered the 2019 level of output. We'll get there. But the fact that we're in the middle of 2021 and annualized output is not at the level of December 2019 is shocking. China's slowing down. Japan has got if you look at the graphs, you can get all this on the Johns Hopkins coronavirus dashboard, and they have a global graph, but you can also break it down by country, and you can see the waves. I mean, it's like a sine curve. So Japan's in a new wave. The United States is in a new wave, and Europe as well, Australia. So we're going back to all these lockdown policies. Lockdowns don't work for the disease. They don't stop the spread of the virus, but they do destroy economies. So you got a weak economy anyway. China's slowing down. There are demographic factors at work that are not much discussed, but they're enormous and they're going to get worse. And you asked about Fed policy or central bank policy in general. I can tell you what they're going to do, but I will also tell you that it doesn't matter. The age of the central banks is over. They're impotent. They go through the motions. The only central banker who actually knows what she's doing is Vera Nabiullina of the Central Bank of Russia. She knows what she's doing. She's buying gold, basically. She's taken gold up to 20% of the Russian reserve position is now in gold, physical bullion. So she knows what she's doing. The rest, though, I used to like Mario Draghi because he was actually smart enough and self-aware enough to know that they couldn't do anything, but he was a great actor, a great Italian actor. Whereas our central bank chairman, I think, are self-deluded when they think that they have some influence on policy. But look, the answer, what's in the toolkit? The answer is nothing, but it doesn't matter because the toolkit doesn't work. So rates are zero. The U.S. is not going to go negative. Europe and some others have with a policy rate. U.S. is not going to go negative. How many more bonds can you buy? I mean, they're actually damaging the global financial system by buying bonds because QE doesn't work. We know that. When they go, so why do rates drop when they go when rates drop when they stop the QE? When they start the QE, rates go up. Well, that seems counterintuitive. It's like, well, if the Fed's buying bonds, shouldn't that drive the rates down? Well, the answer is the minute they start buying bonds, everyone says, we must be in trouble. And then when they stop, they say, oh, okay, well, as long as you were buying bonds, there was a little bit of hope, a little bit of something to prop up the economy. But when you stop buying bonds, now we're going to go straight down because you pulled out that one support. So, but if you want to say, Ron, just to wrap up, if you want to say what matters, what do I look at? What metric tells me more than any other metric? The answer is the yield to maturity on the 10-year Treasury note. On March 31st, it was 1.745%. Yesterday, it traded briefly at 1.18%. It might be 1.2 today. I haven't looked at it this morning, but that's huge. The idea that DV01 dollar value of 1 basis point is the DV01 is higher when the absolute level of rates is lower. So going from 1.7 to 1.1 is not the same as going from 5.7 to 5.1. The spread's the same, but the dollar value in terms of capital gains is much greater. It's amplified at lower absolute levels of rates. So this has produced huge capital gains for investors in 10-year notes. And that was one of the ones I was recommending, and Rosie and others. I wasn't the only one by any means, but there was a small group of us who were in the disinflationary camp. Lacey Hunt is another one, but we were all recommending, get your 10-year Treasury notes. They're going to rally, and they have. So that will probably continue, but that's a sign when you see yield to maturity go from round numbers 1.75 to 1.2 in 3 months. That is a certain sign of strong disinflation, of slowing economic growth. You can look at certain segments of the yield curve and see that they're inverted. That's a signal of recession. So these are very bad economic signals. But the central banks don't matter. That's my point.
Thanks, Jim.
Great.
Mark?
If I may, sure. If I may hop in here. I think, I think you had a great call the last time. You're right. You really were the lonely fighter. And I mean, so far, inflation prints still are high, but also these, I would expect, especially in regards to the now falling commodity prices, they probably will start cooling down and get lower again. But if we have a look, for instance, a little bit on the commodity sector, so commodities had a great run and now seem to be correcting somewhat, or quite a bit actually. Perhaps I think, and since we also want to talk a little bit today about energy, especially, energy was quite interesting. If one had looked at oil, oil futures were in backwardation quite extensively actually, and I think that was kind of a warning signal already. How would you, Jim, view the energy sector? Because you do have some experience, as we learned, and also some interesting investments in the energy sector. What's your outlook when it comes to energy prices, and how do you combine this with your other disinflationary outlook generally?
Mark, on the commodities, I'll talk specifically about energy, but if you want to look at one chart that tells the whole story, look at the chart on lumber futures. It goes in February and March, it goes vertical, it goes hyperbolic. And I would be in debates like this, inflation, deflation. The inflationistas would yell, lumber, 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 look at lumber, look at lumber. I did look at lumber. It fell off a cliff. And it's like, oh, did it retrace the gain? No, it's lower. It's lower now than it was in February. So lumber went straight up and straight down. Okay, that's a blip, that's a spike. You know, you could have made or lost money if you're trading lumber futures. But my point is, it's not inflation. A 60-day blip is not inflation. Inflation is persistent, pervasive. It's across the board. Lumber went up, gasoline prices went up. Okay, but electronics went down, clothing went down, tuition went down. People are they're asymmetric in terms of they're very sensitive to the things going up. Well, I am too. I buy gasoline, I buy groceries, but they tend to take for granted the things that are going down, like it's a gift, like you deserve that. Well, okay, but inflation is a basket, so that's how you have to think about it. Now, specifically on energy, I have done quite a bit of research on this. People, there's a group, and I'll include myself, who make fun of the science, but it's with a capital T and a capital S in quotation marks, the science, because science has been abused and manipulated, and scientists themselves have sold out scientific principles in the same way that a lot of journalists have sold out journalistic ethics. And they're, you know, working for institutes and research grants that have that are among either the climate alarmists, which are different than climate scientists, or people with a hidden agenda. But if you look at real science with a small t and a small s, it would say the following. Is there some evidence that global temperatures are rising? Some, not really conclusive. There's a mixed bag, but there's some. It's rising very slowly. A real expert would say that there's nothing cataclysmic coming. There's nothing existential coming. Maybe a slight warming, but that could reverse. There are certain things in the atmosphere, like aerosols, that actually tend to cool the planet. There are other things that have a more powerful warming influence than CO2, and those would include solar cycles, volcanoes, and most importantly, ocean currents. We just started a new La Nina, which could, could get some nasty hurricanes out of it. If you look at, you'll see people like my friend Gillian Tett at the Financial Times. She's kind of, I call her MS period. I call her Ms. Information, short for, misinformation. But she was screaming the other day about sea levels are rising. Well, I looked at the data. The data is available. Sea levels are rising about 7 inches per 100 years. So, you'd be lucky to get your feet wet in the 22nd century with what's going on. The idea that cities are going to be inundated, islands are going to be overrun, the New York subway system is going to be flooded. It's all nonsense. It's all lies. It's all propaganda. As I say, 7 inches per 100 years. That's if it continues, which it may not. And here's the real point. The data I just cited has been true for the past 100 years. There's a sea level gauge at the Battery in New York. There's an old fort down there, and it's been going strong since the early 19th century. So they have that data. And it's rising about 7 inches per 100 years. And it's been true for 100 years, long before automobile emissions took off, long before a lot of other sources took off. Does CO2 tend to trap solar? The sun comes in, heats the earth, and then the earth radiates the heat. CO2 and methane do tend to impede that shedding of the heat. But how much compared to other sources? How much is caused by humans versus other sources? How much methane release is natural? These are all important questions. They deserve science, they deserve research, but they don't deserve hysteria. So that's sort of my baseline, which is, watch it, research it, and be honest about it. But all this hysteria and drum beating and moralizing, and again, Gillian Tett's kind of the leader. She's like a majorette out there with her baton, is all nonsense. So, and it's not backed by science. I don't care what the New York Times says. New York Times I read the New York Times where I used to read Pravda, which is people during the Cold War, and people say, well, Jim, why do you read Pravda? It's all lies. And I said, well, yeah, I know, but it's good to know what your enemies are lying about, because it tells you what they're really thinking. You can use inferential methods. So the New York Times is pretty much all lies, but I like to know what they're thinking. So with that said, it's just the case. It's just the case that even if you switch to wind turbines and solar, and I know a lot about both, but more about solar. Hydroelectric has been around for a long time. I mean, we built, Boulder Dam, and or the Hoover Dam and the Grand Coulee Dam and all the projects, Hydro-Quebec. A lot of those projects were built in the 1930s and yeah, it was many 40s and many more recently. So there's nothing new there. You have the Three Gorges Dam in China, and that does produce a lot of electricity with no CO2 emissions. So yeah, that's a good thing. And you have environmental concerns, creating reservoirs and lakes and ruining canyons, but that's the part of the trade-off. But the point, but the notion that, oh, just one more footnote, electric vehicles, I guess China is the biggest buyer consumer of electric vehicles. 55% of China's electrical output comes from coal-fired plants, and they're not particularly clean. So when you take your electric car, you're very virtuous. So I have an electric car, and you plug it in, you're burning more coal and you're adding more CO2 emissions than an internal combustion engine. So you pat yourself on the back, but you're contributing to the problem. These are the things people don't think about, and Julian Tett won't tell you. But that said, global energy consumption is going to be greater than projected global energy output, including oil and gas. In other words, wind turbine has a future, solar has a future, uranium certainly. We'll talk about that. I'm not saying the idea that this is binary is that you either have to go completely, emissions free, or we're going to ruin the planet with oil and gas. That's, first of all, both statements are not feasible. They're both not true, and it's a false dichotomy. So the energy future is going to be the following: wind turbine will grow, solar will grow, hydroelectric will grow, but none of them will grow fast enough to satisfy the energy consumption requirements of the planet, particularly when you look at developing economies in Africa and parts of South Asia, India, probably number one. And so therefore, oil and gas are not going away. They're not going away. So it's not either or. You'll have both, and you'll need both because you're not going to be able to power the planet. And so when I see a good company like Exxon, I mean, this whole engine number one thing and knocking people off the board. I mean, Larry Fink can pat himself on the back, but ExxonMobil is the most sophisticated, advanced oil and natural gas production distribution company in the world. Why should they be involved with windmills? I mean, what's the point of that? But Larry Fink thinks it's a good crusade. But my point is, when you see those companies beaten down, if they're well-managed companies, those are very good buys because it's not going away.
Thanks, Jim. I think that's a very, very interesting point that you're making on La Nina. We followed it for quite a while because now we've got 2 La Nina years in a row, which means, probably a very cold winter again. Good skiing conditions. That's that's the positive. And there's also a very high correlation between commodity prices and La Nina years. So I think that's a very interesting point that you're making. I would like to lead over a little bit more to Christian, because you mentioned a very interesting thing, Jim, which is this change of zeitgeist. We saw this revolution at Chevron. So Chevron shareholders, basically, they voted against management and they directed the company to cut greenhouse gases. We saw Exxon shareholders defied the executive suit, and they voted, I think, 3 independent directors with the goal of pushing Exxon to reduce its carbon footprint. We saw something similar with Royal Dutch. And now the big question for me is, isn't it perhaps some sort of a Pyrrhic victory? Because as you rightly say, demand keeps rising. And I think perhaps it would be important for Christian now leading over to uranium, which is a highly emotional topic. And as you know, we're a boutique fund manager. And when we say, well, we've got a very specialized product that invests in uranium stocks, everybody says, well, how can you do that? Are you supporting nuclear bombs? And are you financing regimes in Iran and in North Korea, whatever? But there is lots of misinformation, I think, about the uranium space. So Christian, could you give us a brief overview about your investment hypothesis and the supply-demand first?
Yeah, thanks, Ronnie, for that. You know, we as investors are entering the uranium space driven by the idea that we are looking for the actual demand-supply situation. That is the main driver behind our activity. We are not supporters of nuclear energy per se. So it is the market condition that makes it attractive for us to do investments in the uranium space. And what we see here is increasing, strongly growing supply gap. That means actually in the market there is, after a 10-year bear market, there is definitely a supply side that is under pressure. We have seen production cuts over the last 5 years, and we ended up in a situation where last year a demand for approximately 180 million pounds of uranium, and on the other hand we had a production from the mine side of approximately 125 million pounds. So that is a huge gap between demand and supply. And this is covered by a decrease in existing inventories and from secondary supply. But our investment hypothesis means that over the coming 5 years, this supply gap will close by increasing uranium prices. And that is the main point why we are active in the uranium space.
Now, Christian, I think, you know, the whole ESG topic nowadays is something that's really, really important. And to me, sometimes it seems like a bit like virtue signaling, because everybody is so concerned and so cautious when it comes to sustainability and so on. And I think, you know, we chose the slightly provocative title about the monetary climate change, because I think it's also important to talk about, you know, the consequences of our monetary system, the consequences of the debt situation for us, and especially for the next generation. And nobody really talks about this climate change. However, it seems that, you know, when it comes to ESG and this whole green movement, most people only consider, as Jim rightly said before, solar energy and hydro energy, as well as wind energy. But I think it was pretty interesting that Greta Thunberg, she grudgingly had to admit that nuclear power might be for some sort of a transition phase. It might be probably the only way to go. So how does nuclear energy fit into the whole ESG development from your point of view?
I think the main point to understand is that it's important to stabilize a grid. It's a difficult thing, you know, and when we are talking about ESG accepted energy sources, then we are talking, as Jim said already, about wind turbines, solar panels, and water as sources of electricity production. But that is quite a volatile business, because solar power is just arriving when the sun is shining. Wind turbines depend on the blowing wind. So that means in a dark night without wind, it's difficult to produce any electricity from these sources. And as an additional source, you need base load to stabilize the grid. And in the former days, and in China, for example, still today, the main source of this is coal power. And when you want to switch that off to reduce your CO2 emissions, you have to look for a substitute. And then that's the point when uranium or nuclear power plants coming into the game. It's CO2 free or a low CO2 source of base load. And I think that makes the nuclear power plants attractive in a future energy mix. And that is probably the main argument why we are talking even in the German-speaking part of Europe about extend the life cycle of existing nuclear power plants.
Thanks, Christian. Jim, I just read your brilliant piece, Climate Change, Climate Alarm, and Energy. And actually, I knew that you have installed a PV system, but I didn't know that it was that big. So on your farm, you've got a PV system consisting of solar modules, solar panels, and steel pylons. But you've got it not primarily to save on your electric bill, but to be independent in the event of a collapse of critical infrastructure. So perhaps if I may ask, I would like to learn a bit more about the system in the US when it comes to, because over here in Europe, it is heavily subsidized. I think otherwise most people would never think of installing a PV system. I think nobody really expects a collapse of the energy infrastructure. So you're definitely having very unique thoughts on this topic as well. So how does it work in the US? And if I may ask, how much are you producing? How big is the whole system?
Sure. The system I built is, just to be specific, it's the largest private system in New England that's not connected to the grid. So there are larger systems, but they're owned by towns or industries or whatever. It's occasionally a drive by, you'll see acres of panels, but it was put there by a town or a county or a government business. So this is private, and it's not connected to the grid. And that was important to me because I have a master switch. I can go from solar to grid. The grid's still there, but they're not connected at any point. That's what two switches like that do that. And there were, I think, we did a lot of research with my caretaker, and we did. There were 13 companies that could install these solar systems, the PV systems, but only 3 would do an off-grid system. The rest of them, what they do, and you see it in Europe, you see it in the United States, is you'll drive by, you'll see someone's got solar panels on the roof. A modest house, bungalow, ranch house, whatever, and they got solar panels on the roof. Well, there are literally people who go almost door to door, and they'll sell you on this, and you put solar panels on your roof. They connect you right to the grid. So kind of as Christian was saying, you're not powering your house, you're feeding the grid. And then they're giving electricity back to you. And it's all metered. So you have a contribution of X and you take Y, and X minus Y, if that's a negative number, they'll send you a check. And if it's a positive number, you pay them, but it's less than you would otherwise pay. People seem not to realize that you have to pay for those systems. They give you a 10-year equipment financing deal, but they put a lien on your house. So if you sell your house in the meantime, you got to get the buyer to pick up the obligation on the solar system. That comes as a shock to some people, or else pay it out early. That's a financial shock. So, and do they actually produce enough electricity to power that particular house? Usually not. They produce some, of course they do, but it's not necessarily as much as you're using. So do they contribute to the grid? Yeah. It's very intermittent for the reasons Christian said. And I've learned that with my own system. So we wanted something that would power the house. We produce about 7 kilowatt hours, which is enough. So that's basically 7,000 watts per hour. 70 100 watt bulbs burning constantly. That would be what it is. You get no electricity at night. I'm in New England, so when you know what weather's like in the Alps. It gets snow and cloudy days. You don't get any electricity on those days. And by the way, and this is another thing people don't quite understand, the house is not powered by solar. Solar charges the batteries, and then the house runs on the battery power. So what you have to monitor is the batteries. How charged up are they? So what you end up doing, this is just human nature, you kind of adapt your lifestyle a little bit. So let's say the sun's shining. It's really use it or lose it. I can't use enough electricity on a sunny day. So that's okay. Run the washing machine, the dryer, the dishwasher, the hair dryer, whatever you want to run, just run it that day, because you're not going to deplete the batteries because you're getting more electricity than you can use. But don't run the washing machine at night because you are draining the batteries. Now, that's not a big deal. So, you do your laundry at 10 in the morning instead of 10 at night. Okay. But you find you're making those behavioral adaptations, which are not difficult, but they're just common sense. But that's how you learn to live with the system. But but I have a much smaller carbon footprint than Greta Thunberg. I have 75 acres of trees. So those trees are carbon, CO2 sink. People forget, they get rid of carbon dioxide. It's like, well, you're going to kill every plant, every green plant on the earth will die if you don't have enough CO2. So there's some argument that we could use a little more CO2. But with 75 acres of trees as a carbon sink, and with a solar PV system producing the energy that we use, so there's no net taken from any other system, my carbon footprint is negative. I'm actually taking more CO2 out of the earth. So I'm probably better than Greta, who's flying around or getting sailboats around what she's doing. So I don't have to. So I can be objective about climate without being defensive because I'm doing my bit. But for example, I had to clear several acres to install the system, and I included a picture of it in the newsletter you're talking about, Ronnie. And yeah, I run into these people like, oh, you don't need that much land. Well, yes, you do, because we have trees. You don't want a tree to fall on your pylon. Now, if you're in the middle of the desert, there aren't any trees. Okay, desert's probably a good place to put a solar system. Although then you get into logistical issues, the kind of Christian was referring to, which is, well, how far are you from the main from the main lines, from the power lines, and how far are you from the grid? You have to build new infrastructure to get to the grid, et cetera. But you can't just plop a solar panel, a pylon my panels are 9 feet by 15 feet. They're made of 9 3x5 panels, so the whole array is 9 feet by 15 feet, 3 meters by 5 meters roughly. On steel pylons, they're about 10 feet high each, so and there are 9 of them. So so it's a pretty big system, but I had to clear acres of land to do that safely so that the trees in storms, because we get high winds in the mountains, don't fall on them. Well, it runs my house just fine, but that's a lot of land and a lot of infrastructure and a lot of pylons and a lot of panels to run one house. So how are you going to run cities? How are you going to run large, densely populated communities? I'm not saying you can't put some solar panels on your roof, you can, but you're kidding yourself if you think that you're going to run densely populated areas with solar power. Again, here and there, yeah, and then you want to put it on your new university building, go for it. But again, it's naive and just not scientific, not rational to think that you can run large population centers on anything other than oil and gas, unless you use nuclear power. Now, the problem with nuclear power, it actually works fine, and it has no CO2 footprint, or practically none. Lasts for a very long period of time. It's very clean. You have the disposal problem, yeah, but there are solutions to that. There's a lot of safety checks and so forth. I'm not saying it's risk-free. It isn't, but it's very clean on a relative basis. But what you run into, the opposition is really political. And you kind of referred to that. It's like, well, we don't like nuclear. We don't like radioactivity. We don't like, the whole idea is kind of, scary to us, or we just don't like it on ideological grounds. Well, now you're not being scientific anymore. You're not being rational anymore. You're injecting an ideological agenda. So to Christian's point, why don't we have more of it? Because it's a really good solution. I mean, there are logistical limits on hydroelectric, but hydroelectric is very clean. The other sources I mentioned are clean, but they're really constrained because they're intermittent. Again, Christian described it perfectly. You got to keep the base load up, or the whole system will shut down. but why not more nuclear plants? France is very good at it. Russia is very good at it. The United States used to be. I don't know if we still are. Maybe not. But you know, you'd want the French or the Russians pretty much to build your nuclear reactors. I'd go with the French. But the point is that the limits on it are not logistical and they're not scientific. They're political and ideological, which unfortunately taints the climate change, climate alarm, energy usage, all the things we're talking about are infected with ideological constraints that stand in the way of good science.
Great, thanks. May I interject a question here for Christian, because I think this is a little bit our Western worldview. Obviously, Western countries are more reluctant to embrace nuclear powers, but as we already touched on already, we see emerging market countries which I think embrace this technology heavily. Christian, can you give us a little bit of an overview of what is basically in the pipeline when it comes to future plans?
Yeah, thanks for that, Mark. The main driver behind the growth is definitely Asia. It means China, India, and even Japan is rethinking about new construction of power plants. So actually, there are 18 power plants under construction in China. And the reason for that is that is not primarily substitution for coal-fired power plants. This is additional capacity to cover the needs in the grid, because these economies are growing still on high levels, means 6% plus. And that means because electricity consumption is strongly correlated to GDP growth, that means strong growth on electricity consumption side. And nuclear power plants are a good way from their point of view, because that is a smart way to reduce all these pollution issues we have, especially in the bigger cities and in the industrial areas in China or in India. But the second point is probably to solve the issue of dependence, because it's a smart way to diversify your sources of energy, and makes you probably less dependent on imports on the fossil fuel side. That is for sure a second important issue. And the third is probably that the timeline in this country are totally different from what we see in the US or in Europe. To build a nuclear power plant from scratch is still not possible in Europe within a useful period of time. But in China, you're still able to realize such a huge project within, let's say, 10 years from the beginning up to put it on the grid.
So that's 18 from China alone. Which are the other fastest growing countries, perhaps in this?
Yeah, India for sure is an important driver also for growth. But we also have Middle East power plants under construction, and probably an interesting driver in the whole industry is Russia, because Russia is delivering nuclear know-how to the world. They are constructing nuclear power plants all over the world, in Turkey, in Middle East. And so they have a different understanding. They see themselves as a one-stop shop for all your electricity power needs. They deliver you everything from the plants they build, the power plant, they will deliver you the fuel you need and help you to clean it up at the end of the life cycle. So is everything coming from their side as a full package? and that brings Russia in a situation, I guess they will be a net importer or buyer in the uranium market at the end of this decade, I guess.
Sorry, Ronnie.
Christian, I would like to ask you, because we've seen quite a lot of excitement. I think that over the last couple of months, uranium became a topic again. So we saw some newsletter articles. We see that, for example, our friends at Sprott, they are currently launching a physical uranium trust. We saw that the big producers did really well. And it seems that the general market sentiment regarding uranium has become much more positive. But what I would like to ask is, from your point of view, where are we in the cycle at the moment? Is it still early stage, or do you think we're already in like a little bit of a mature phase of this bull market?
Yeah, I would say the bottom is in the market. So time for bottom fishing is probably over. It's more, the issue now is more buy the dip as the situation it is actually in the market. So I think we entered a long-term bull market, and that will drive prices higher. Probably you can have a look at long-term charts, and then you will see that the last high in the uranium market was around $130 US per pound. We are now trading a little bit above $32. There's still quite a long way to go. But what you have to mind is the gap between the underlying commodity and the performance of certain uranium stocks we have seen over the last months. Means some uranium stocks are valued quite aggressively now. That is probably the reason for the profit taking and the short-term correction we are seeing in the market actually. But you made a good point. I think Sprott and friends are game changers in the uranium market, and I think what really changed is these guys made the uranium space investable for institutional investors. The changing in the zeitgeist is probably one issue, not to exclude nuclear power stocks in general, uranium stocks in general, but you have to make sure that these people are able to invest in the uranium space. And we have seen interesting things. These physical uranium trusts, Yellowcake and uranium participation. That is probably a good place to invest for institutional investors. And then are also uranium ETFs established in the market, especially in North America. And also this gives institutional investors an opportunity to invest in the market. And on the other hand, that increases market liquidity, market cap of the stocks. And it's depending on all these factors. I think that changed the situation heavily over the last 12 to 18 months. And also our fund was a little bit more in the spotlight over this period, and that was the reason why we had the chance to increase at least a little bit our assets under management.
Well, it was quite significantly. Could you give us? I'm not sure if you or we are allowed to mention specific names, but could you tell us a little bit more about your current allocation? How much of the senior producers do you have? Do you invest in uranium explorers at all? Because I can imagine they are even more volatile and even more illiquid than the ones in the junior gold mining space. So what's like your current allocation like?
you know, it's a highly volatile market, the uranium space, and probably this comparison to junior gold mine market is a good one. It's more or less the same situation there. So our investment strategy is based on 4 pillars. At least we are holding always quite a high quota or portion of cash, just to make sure that we are able to act in a volatile market. So that means a cash level of 9 or 10% is not unusual. Actually, we are 20% plus, slightly above 20% in liquidity, because we still expect a continuation in this consolidation we are seeing in the market. The second pillar is, I would say, the core of the portfolio. This is the bet on the uranium price through the investments in these physical trusts we talked already about. Uranium participation and yellow cake are cornerstones in the portfolio, because our investment hypothesis says that over the coming 5 years, the supply gap will be closed by higher uranium prices. So it makes sense to have exposure directly to the uranium space, and to make a normal uranium producer profitable, you need probably uranium prices of 50 or 60 bucks per pound. That means there still is a double in the cards over the coming years with these assets. In the same group, I would place our investment in Uranium Royalty Corp. This is the only royalty company with focus on the uranium sector. I love royalty companies. I think this is a good concept for conservative investors to participate in a commodity sector without having execution risk on specific mines. So normally this group makes up between 15 and 20% of the portfolio. The third group are all uranium producers and standby producers. The standby producers means company, they are able to start production or restart production within the coming 12 to 24 months. And here, the 2 heavyweights in the sector, Cameco and Kazatomprom, are prominent positions in the portfolio. Actually, there are together probably 16% weighted, and all these producers, standby producers together, maybe a third of the portfolio. And the rest is allocated to the development and exploration camp, mainly focused on developers, because we are not doing heavy bets on companies with the potential to produce in the next or in 2 cycles later in the uranium market. So our main focus is this 5-year time horizon. So there are explorers and developers where we can see on a micro level developments that support higher valuations in this time frame. But yeah, this is probably another 20% of the portfolio. So built on these pillars, 4 pillars: cash or liquidity, physical uranium exposure. The third one, producers and co-producers, and then the rest allocated to the high flyers of tomorrow, probably.
Thanks, Christian. It's very interesting, and we're very proud about the fund under the roof of Incrementum that is doing really well. And I have to admit, yeah, for us as slightly younger colleagues and fund managers, there's really a lot to learn from you and your vast experience in markets. Thank you. Well, I think we have to talk about gold, at least for a bit. I mean, Q3 has very, very positive seasonal tailwinds coming in. I think in the last 20 years, Q3 was actually the most positive quarter for gold. We are currently seeing, as I said at the beginning, it's definitely a risk-off move. And I think the gold-silver ratio is telling us that the market is now rather seeing gold as some sort of a disinflation or deflation hedge, while silver is pretty much unloved at the moment. Jim, where do you see gold now? I mean, I think we all agree that gold is more of a monetary insurance in these turbulent times. But at the moment, do you regard gold as a buy, or are you pretty much neutral on the price of gold?
No, I think it's a buy, Ronnie. I mean, I'm actually impressed with how well gold has held up considering the headwinds, considering, we talked about earlier, where if we're not in a deflationary environment, in my view, we're definitely in a strong disinflationary environment. So interest rates are coming down, inflation is coming down, growth is slowing down. That's not, if you look at nominal rates minus inflation, well, if inflation is coming down, that means real rates are going up. They can still be negative, but it's a smaller negative. So those are all headwinds for gold. That's not the ideal environment for gold. And yet gold has maintained itself in this range. Now, I know, I guess about 3 weeks ago, we had that air pocket, dropped 5% in one morning. I watched it with interest, and then it kind of crawled back. It's not all the way back up to where it was. But the fact that it, kind of crawled back up to, right now it's around $1810, $1,810 an ounce, give or take. It was a little bit higher a few days ago. That's fine. I mean, it's normal volatility. But the wider range for a much longer period of time, going back almost a year, it peaked at 2069 in August, I think August 6, 2020. It's been down since then. But for about 7 or 8 months, it's been trading in a broad range of around 1700 to 1900, with a central tendency around 1800 and kind of moving between 1775 and 1825. It's been pretty much in that range. And so when you have as many headwinds as I described, and other than, occasional air pocket comes back, so there's daily volatility, that's not unusual. That's just, some of that is, it can be short covering or people getting out of a position, or momentum driven or computer driven, the reasons for kind of overshooting, undershooting. But it's kind of hanging in there in a not great environment. So you change the environment and, bring interest rates much lower, and I think they are going lower. Gold will continue, and then, you look around the world. So we talked about earlier, Australia is shutting down again. France is the rioting in France because you can't get into a cafe unless you have a vaccination. I mean, some of this is science versus politics and ideology versus common sense, but some of it is just frustration. I mean, people are fed up after a year and a half of this with the masks. I was just reading the viruses weren't really well understood until the 1930s with the invention of the electron microscope. They were hypothesized, but you couldn't actually see one until the early 1930s. The COVID virus, the technical name is SARS-CoV-2, is 1/5000th the width of the weave in a mask. So take a mask, put it under a microscope, and see the weave, the woven fabric. The virus is 1/5000th of the weave. Now, the virus will go right through a mask. Someone said it's like shooting marbles at a building scaffold. Every now and then a marble will hit the scaffold, but most of them are going to get through and hit the building. And so the masks don't do anything, but we have to wear them, they say. And I flew down to Florida a couple of days ago. I didn't have to wear a mask anywhere, certainly in the state of Florida, except on the plane, which is stupid. But anyway, I did because they would arrest me if I didn't. But we're sort of powering through all that. and yet gold, as I say, continues to hold its own. Now, one thing that's not well understood, and I'm working on a research project on this. Gold does extremely well in deflationary periods. Everyone gets the fact gold does well in inflation. I got inflation's going up, prices going up, gold is going up. Gold is a good hedge against inflation. All true and pretty well understood, pretty intuitive. What's not intuitive is that gold does very well in deflation in two respects. One, even if the nominal price goes down, the real price could be going up in a deflationary environment because every dollar is worth more, number one. Number two, it can outperform other asset classes. So it goes down a little, yeah, but if your stocks are going down a lot and other assets are going down a lot in a deflationary environment, gold might outperform those assets. But at the end of the day, and this goes back to what we said at the beginning, with central banks not having a toolkit or not knowing how to use the toolkit, or the toolkit doesn't work, et cetera, all of which is true. There is one tool that does work, that has always worked. And when disinflation becomes persistent enough, or deflation breaks out, and it gets to be now 14 years, 15 years, 20 years, how long do you want to go on before you get the inflation you want? And if you don't get the inflation, what's happening to the debt to GDP levels? Well, they're overwhelming you. They're slowing growth in and of itself. That's what Ken Rogoff and Carmen Reinhardt have shown through their research. You got to get rid of that debt. And the only way to get rid of it, you can default. But the U.S. is not going to default because we can't print the money. And here it is. Good luck buying a loaf of bread. But we're not going to default. But the only way to get rid of the debt in real terms is with inflation. So at the end of the day, you must have inflation. But central banks have shown us for 14 years that they don't know how to get it. Well, I know how to get it, and I can tell you, I think a lot of the audience says, you just raise the price of gold. You just wake up one morning and say, you know what, as of now, gold is $5,000 an ounce. And if you think that's cheap, come and get it. The doors of Fort Knox are open. If you think it's expensive, shoot it in, we'll buy it, pay for it with printed money. By the way, that'll get you your inflation. But the point is raising the price of gold, which Nixon did in 1971, and Franklin Delano Roosevelt did in 1933. The Bank of England did in 1931. The Banque de France did in 1936. Raising the price of gold is a surefire way to get inflation. So in normal inflation caused by any one of a number of macro reasons, psychological reasons, increased velocity, et cetera, gold will just go up. That's what it does. Which isn't really, gold's not really doing anything. It's a metal. It's the same, the weight's the same. What's happening is the dollar is declining, so it takes more dollars to buy your ounce of gold. And so everyone says price of gold went up. I say, no, gold's the same. The dollar devalue, that's what's really going on. But gold's a good place to be. But the notion that in persistent deflation, or the absence of inflation when you need it and you don't know how to get it, you can just raise the price of gold. Governments can do it on their own. So that's why one reason why gold performs well in deflationary and disinflationary environments. So gold wins either way. And so I would say now it's a very attractive level.
Thanks for that. May I just interject? I think it may be noteworthy that our inflation signal recently turned. We've been capturing this uptrend in commodities quite neatly. But 2 weeks ago, the momentum of the inflation-sensitive assets, which we are following with this signal, came down significantly, which also led us to reduce the inflation-sensitive assets in our fund. We actually did increase the gold allocation relative to the silver allocation, also due to similar thoughts and rationale, as Jim just mentioned. So actually, we are now also basically aligned in our views that the market is just telling us inflation momentum is decreasing, and we'll see how far this goes. But I think this is a very, very exciting phase in the market cycle, because everybody was just thought it was for granted that this growth will just keep continuing, and with this growth, this inflation will keep perhaps continuing or stay transitionary. We will see. Anyway, I thought it's worth mentioning inflation signal going down.
Yep, absolutely.
And that's the reason to take a hard look at commodities. Lumber is my favorite poster child pinata, so to speak. But lumber has crashed. We still have a lot of other things. You're absolutely right, Mark. But I'll speak for myself. I don't consider gold to be a commodity. I understand it trades like a commodity. It's on commodity exchanges. It's in commodity indices. I understand all that. It's actually not a commodity because it's not good for anything except money. But it's the best form of money. So when I think of entry points for gold, buying or selling gold, I don't think of it in the commodities complex, which I would apply to oil, natural gas, lumber, cement, agricultural products, copper. Yeah, lots of stuff in that commodity basket. And it's very important. But I think of gold over here in the money basket, and it's really more about confidence. And so if we see diminished confidence in central bank money, what I call command money, then that's very bullish for gold as well.
Absolutely. And over here in Europe, I see some lack of confidence in Madame Lagarde, who now wants to save the planet with her new green mandate, it seems. But we can talk about that at a later date. Gentlemen, it's been a great pleasure. Jim, as always, thank you very, very much for taking the time. Christian, as a special guest, thank you for interrupting your vacation. Say hello to the family.
I will do so. Thanks for the opportunity to share some ideas with you.
Thank you very much. And if our readers or viewers have questions about the fund, you can find the information on our webpage. We can send you a presentation or the fact sheets. You can approach Christian. All the contact details are on our webpage. So, yeah. It's been a great discussion. Thank you very, very much. We now look forward to taking some days off, and then I look forward to another advisory board discussion. So thank you very much. Stay healthy. Have a great summer and see you soon. Bye-bye.